Hello, everybody, and thank you for joining me again on another episode of Powerhouse U. Today, I am accompanied by Darryl Murphy Sr. Darryl Murphy is with Murphy Baynard Group, and what they do is syndications. And then I'm going to let you guys know what the definition of a syndication is, which will actually give you a little bit of insight on what Darryl does. And then we're going to go to a Q&A session after that, and also let you Darryl give his introduction. So basically, taken from the Forbes.com, a real estate syndication is when a group of investors pool money together, their capital to jointly purchase a large real estate property that could be apartments, mobile home parks, land, self-storage units, and other real estate assets where some investment opportunities are available through real estate syndication. And then that's basically by definition what Darryl Murphy does, and I'll let him give you a little bit more specifics about what that is and how you guys could join.
Sounds good. Yeah, a syndication. Well, really, the whole conversation is what you read. It is a pool of investors, right?
Who are you,
But there's
Darryl?
Oh, I didn't even introduce myself.
Who are you?
Yeah. So I'm Darryl Murphy, Darryl Murphy Sr. with the Murphy Baynard Financial Group. And what we do is we do syndications. We acquire these large assets, commercial multifamily apartment buildings, and we ask other people who would like to pool their money with us. I like the way you put that too. Thank you.
You're very welcome. You're getting straight to it. I
Yeah.
respect that. All right, so that's what it is. So what's your title with Murphy Baynard?
I'm the managing manager
The
for the
managing.
Murphy Baynard Financial Group. Yeah.
Okay. All right. And then, okay, so syndications. And
Mhm.
what I read was pretty much on point. So yeah, feel free to elaborate on this point, at this point, about
Okay.
what you do.
Okay. So what I do, I acquire assets, and then I go to a syndication attorney. We form a syndication, and it's either going to be a 506B, which is an accredited for non-accredited, or a 506C, which is for accredited. And so, the United States definition for what to be an accredited investor is, you can find it in the SEC rule 501, and that's in the Reg D where you can find that. Okay, but to be an accredited investor, a person must have an annual income exceeding $200,000, right?
Hmm.
Or if it's a husband and wife, $300,000 for joint income, all right? And it must be for the last 2 years, with the expectation of earning the same or higher income in the current year, right? So an individual must have earned income above the threshold, either alone or with a spouse, over the last 2 years. Now, a person
So
is
to be an
also
so
right.
in order to be an accredited investor, you actually have to meet a financial threshold,
Correct.
and that's going to be the difference between accredited and non-accredited.
Correct. And a person is also considered an accredited investor if they have a net worth exceeding $1 million, either individually
Hmm.
or jointly with your spouse. Okay.
Okay.
So the SEC also considers a person to be an accredited investor if they are a general partner, executive officer, or director for the company that is issuing the security. So
Okay. So SCC stands for
Security Exchange Commission.
Security Exchange Commission. So, and then two, to be accredited, you have to meet a minimum threshold. And then did you say
Right.
or a dollar amount for the assets of 1.5? Or that's
The
and.
you must have a net worth exceeding $1 million.
Okay, so okay, is that and so you have to have the $250,000 income and have a net worth of 1 million?
No, it could be either or.
Either or. Okay, so either or you could be a GP in an investment group.
Correct.
Okay, or one
Now,
of the other titles.
right. Now, so to make it simple,
Hmm.
if let's just say you were to go out now, let's assume you are a non-accredited investor, right?
Okay.
You go out, you get your deal, you make it a 506c, which is open to accredited investors, but you are the GP on that deal, right?
The general
So there
partner.
you go.
Uh-huh.
You're a general partner considers an accredited investor
Uh-huh.
if they are a GP and you are a GP. So you for that deal, you'll be considered an accredited investor.
Okay, so that's what an accredited investor is. What is a non-accredited investor?
So a non-accredited investor just doesn't meet the requirements. That's all.
But you could still invest even though you don't meet the requirements. Oh,
Yes, you
so
can.
all right, so if you're a non-accredited investor and you don't meet the requirements, you could put in a minimum amount into a deal.
Yes, you
And
can. And
so go ahead.
that would be a non-accredited investor can invest in a 506b raise because 506b raises are open to accredited
Hmm.
and non-accredited. So what's the difference between the two? The
That was going to
accredited
be
and
my next
non-accredited,
question. Yeah.
right?
So
So
that's the difference in the codes too, is accredited and not accredited?
yeah. So the 506c is for accredited only,
Mm-hmm.
right? But the difference between the two, a 506c, you can advertise. I could come on your show right here and I can advertise if it's a 506c. If
Mm-hmm.
it's a 506b, I cannot advertise publicly on your show or any social media.
And why is that?
Of course, due to the fact of the sophistication
Mm-hmm.
of of investing. So, in order for a person in order for a non-accredited investor to invest in my investment, if I had if it was a 506b, I must have had a prior relationship with that person, or let's say you and I are partners.
Mm-hmm.
We're working together on the deal. The person doesn't know me, but they know you. They can invest. Long as they know someone, long as they know either me, you, or one of our affiliates, they can invest in the deal.
So you could advertise the deal word to mouth, but you can't advertise it publicly on a public platform,
Yes, but it should be to a person that you already had a
a
prior relationship
relationship
with.
with. Okay. And then you said that's due to the complex nature of the deal.
Yeah, because a lot of times when you're dealing with non-sophisticated investors, there may be some things they don't understand.
Uh-huh.
The way the SEC looks at it is if you're an accredited investor and you're bringing in over 200,000 or you have over $1 million in assets, there's other questions that they do ask, like if you've invested before, stuff like that, right? But
Mm-hmm.
if the way they look at it is you understand the risk that you're taking for
Mm-hmm.
an accredited investor. A non-accredited investor, they don't understand, they may not understand the risk that they're taking. So with non-accredited investors, you must make sure that you educate them to the deal, make sure that they understand what they're getting into and stuff like that. Okay. If
So
you see a person isn't, if you see um if you see a person really don't understand what they're doing, if I was you, I wouldn't take their money.
right. Okay. So I think I'm kind of putting it together because when you bring in other people on the deal, does that automatically make you a GP because these people have to answer to you on the deal?
No,
No,
it don't
you're just
automatically
a,
make you a GP. No,
okay.
because you could come in on a deal as a limited partner.
Uh-huh.
And LP and GP means LP, limited partner, GP, general partner.
And then
A
the limited
GP,
partner.
a GP has an active role. We actually putting in the work, you know, executing the plan, finding the property, doing the work, and the limited partner is a passive investor. They lend you the money so you could get the job done and stuff like that, and you pay them interest on your money, dividends and stuff like that.
Mm-hmm.
So a passive investor. They don't want that active role. They don't want to be dealing with the property manager. They don't want to be dealing with trying to go out here and find deals. They don't want to have to deal with that. But they give you the money, so you go deal with that.
Right.
And, and
Yeah.
you bring back the return, right?
Right.
Yeah,
Yeah. So okay, so I don't think we discussed it yet, but your specialty when it comes to syndication is multifamily. And then
correct.
right now you're working on a multifamily deal right now and then pulling in money for that. Now, if you can't speak on that one publicly, which one can you speak on to where we could talk about how you guys handle people that are coming with the bare minimum amount of money? In addition to, you and I discussed prior to that there is also a possibility of somebody creating an LLC in order to come in on a syndication deal. So can we talk about that?
Of course we can. And when the Dayton property is a 506B.
Mm-hmm.
No, I cannot advertise and tell you like the returns and this, that, and the other.
Mm-hmm.
And my attorney say, don't say nothing, right?
Uh-huh.
So, if anyone wants to know more, this is what I can say. If anyone
Okay.
wants to know more about the Dayton deal and you may be interested, reach out to me. And
Mm-hmm.
and that's what we are say. When it
Mm-hmm.
comes to other deals, that is a 506C, man, I will post the returns and everything, right? IRR 19 plus, equity multiple 2 plus, the average cash on cash 8 plus, right? And we
Uh-huh.
could we could share that. So, of course, of us being open to accredited investors, right?
Mm-hmm.
Now, let's get into what you said about the forming for passive investors. I'm going to say for passive investors,
Okay.
those that want to get in on it. Let's say, you want to get in on a deal, right? So, but you don't have the 10,000, right? You and I, we know each other. We have history. You can invest with me no matter what, whether it's accredited or not accredited. I mean, whether it's accredited or if it's a 506B, you can invest with me because we know each other.
Mm-hmm.
But let's say you say, damn, I don't have the 50,000. Say, okay, what you can do, what you can do is say, okay, my mom wants to invest. She got 10, I got 10, my aunt got 10, my uncle got 10, and my cousin got 10. That's 50,000. So you get with them and you say to them, listen, are you interested in investing in this deal? And you give them the investors packet, and they're looking it over. They're like, yo, I like these. You know, I like these numbers. These are good. Yeah, let's invest as a group.
Mm-hmm.
So that way it could be 50,000. And so what you could do is start an LLC, and all of you are members of the LLC, and then you can invest in the deal.
So
You
you
wasn't
could
able
all
to
pull
do
your
it before.
money together,
Yeah,
create an LLC, put money into the
right,
deal.
right. And what is that called? When people pool their money together, what's the definition?
I want to say syndication. Am I
Syndication. There you
right?
go.
I'm right.
A syndication is nothing but when people pool their money together to acquire an asset.
Yeah, so you could create an LLC within your own entity or a group, and then you guys just bring your pot to the syndication to you guys.
Yes.
So when
Yeah.
you do it like that, how does that work different than doing it as an individual?
Now remember, you didn't have the 50 grand.
Right. No, I'm saying comparing two people. So comparing a person that does in fact have the fifty grand and they put their
Right.
money in the deal versus an
Yeah.
LLC that had to pull their money together. Now,
Mhm.
what do the returns usually look like on deals like that? Is there really a difference between how you guys split the funds on a
Mhm.
syndication deal?
Remember, it's not it's not you, the people that's investing.
Mhm.
It's the LLC that's investing.
Right.
So the returns that's that's that the projections that's in your investor's packet,
Mhm.
when that goes to when that K1 is cut, or when that distribution when that dividend is cut, and
Mm-hmm.
it's going to be made out to the LLC
So you guys determine how you split the
within
payments
that. Correct.
within the
So within that,
LLC.
yeah, within the LLC. Now, if each of you give an equal amount, I would think that you would split that equally.
Right.
Right.
Yeah.
Yeah.
Yeah. Okay. And then, so on a typical syndication, what's the usual timeline from the time that you raise the funds, um, purchase the property, and the whole time? And
Uh,
how does the process usually go? Like, if I was a client and then I put my money in the deal, how does it go from beginning to end?
okay. So uh, the whole time you usually could run anywhere from 3, 5, 7 years, 10 years, right?
Mm-hmm.
It depends on the sponsor, how they structure the investment. Okay,
Mm-hmm.
whether it's 3 years, 5 years, 7 years, 10 years, and that could be the whole time. When it comes to distributions, right? Distributions can be done however that is also structured, whether it's 1 month, whether it's every month, every quarter, every year. It depends on how they structure it. It also depends on the deal, right? You get into a deal that's a ground up, or let's say a vacant building. There's not going to be any distributions whatsoever until that money starts rolling in, right? So the distribution structure, that could be done depending on the team, how they have it structured. You may get a dividend every single month. You may get one every quarter. You may get one every year, but you will get dividends on your cash.
Okay. So is it safe to say that when you put money into a syndication, it kind of works like the stock market, and whatever your investment in on that is what your percentage return is going to be. So if you invest $10 and uh I don't know, you got 10 people. Look, now my math is off. So you just get you just get your return based on whatever percentage you put into the company. And that's how your check is going to be cut. Like like for example, me personally, I have a Cash App account, and then I put money into a stock, and every month my Cash App gives me a dividend, even though it's only like a couple cents. So if you only put a couple $100 into the deal, which I know you can't, but just hypothetically speaking, if you did, you'll only be getting that quarter back or so, like I get from the stock that I did, and that's pretty much how it works in a syndication.
So comparing it to the stock market, I'm gonna tell it like it is. Commercial multifamily is gonna be it's more stable, way
Mm-hmm.
better. Okay.
Mm-hmm.
Now, when I say way better, it's because there's other factors that comes with commercial multifamily, things
Mm-hmm.
that things that you could take advantage of, taxes, stuff like that, cost segregation, depreciation, right? A bank will lend you money to invest in a building, but a bank will not lend you money to invest in the stock market.
Mm-hmm.
Why? Stock market too risky. You could lose your money. So let's
Mm-hmm.
talk about what you just said, though. So, but the dividend, with commercial multifamily, it could range your average cash on cash, and to be specific, everyone, when I say cash on cash, what that is, that's what is it that you're making off of your money every single quarter, right? Every quarter, what you're making off of that money for you taking the time out of your schedule
Mm-hmm.
to let us hold $100,000, right? So if we have an average cash on cash, let's say keep it around, say 6%, then if the annual for year one is 6% of 100,000 is what, 60 grand?
Yep.
So
I will
for
have to
that
look at my
year,
calculator.
so so for year one, if COC is 6%,
Mm-hmm.
and everyone, that's going to be relating it to your money sitting in the bank. I think that's the best one. Take your money, place it in the bank. How much you get every single year? It's going to be about 0.01. I would tell you, take that money out of the bank invested into a commercial deal where you can at least get 5, 6, 7, 8% year one on a deal. Okay. Year two, it's going to be a little more. Year three more, year four more, year five more. And then when they disposition out, when they sell the property, you'll get your capital back, and you also get whatever proceeds from that sale. You will also get that back. So you could double. You actually could double your money within 3 to 5 years. I was on a deal.
Which is a jackpot, really.
It makes good sense to me and you, right?
Yes,
Hope it makes good
yes.
sense to everybody else. Now, but I was on a team. We owned a property in Augusta, Georgia, 104 units. We acquired the asset, executed our plan with less than 1 year. Plan was executed, property sold, and we more than doubled all of our investors' money within less than a year.
Now that's good. Which brings up another question, because I'm sure a lot of people are going to know, when you purchase property, how do you pick the property, and how are you able to increase the income that investor receives from the property? Let's talk
So,
money.
okay, so how do you pick the property?
Mm-hmm.
That's going to be a long conversation. Of course, there's I can't speak for other investors.
Mm-hmm.
I can only speak for the way I do things and the way I teach things in my mentorship program and the way my team operate. Okay.
Okay.
We have numbers. We have man, I can't believe metrics. There we go. There are metrics that we follow. There are metrics that we follow for the city. There are metrics that we follow for the neighborhood. Those metrics must be met. Okay. And when it comes to finding a property, and as long as that property as long as the neighborhood and the city meet those metrics, that's a thumbs up.
Mm-hmm.
We're going to go for the property. Underwrite the property now. Now we get the financials, which is the rent roll and the trailing 12. We get that from the broker or the seller. We sit down, we underwrite the property. There are metrics, again, that we're going to be looking for, which is what's the IRR?
Internal rate of
What's the
return.
equity, right? What's the equity multiple? What's that
Mm-hmm.
one?
Is it equity multiple?
Right. EM, right?
Mm-hmm.
And what's the COC? The average
Cash.
COC, right?
Yeah.
So as
Cash on
long
cash
as,
return.
correct, as long as we meet each and every one of those metrics, that's where we're going to submit the LOI. This is
Mm-hmm.
the purchase price that we're going with, blah, 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 right?
Mm-hmm.
Now, so that is how I pick my property.
Mm-hmm.
I just don't go out there and pick a market. No, no, we have my team and I, and in my mentorship program, I follow those strict rules, and that's what we go by.
Okay.
So there's a lot of markets I won't go into at all.
And then that too brings up the topic of value add, because when you purchase a property, your intention and your goal is to get these returns that you speak of. So,
And
explain to the
you did
people.
ask me a question about that too, and I totally missed it about the value add. How we
Yes, yeah. So
bring the
yes,
value to the property.
yeah. So
Yeah,
yeah, let's talk about that right now. So when you purchase the property, they meet these metrics, and now you have to do the add value to the property in order to
correct,
ensure these returns.
correct.
So do tell.
Okay, so I've learned a lot during this process of what type of value add to certain properties. You don't want to do, you know, and you have to, I'm gonna tell you, you have to look at people's culture. You have to look at, people, what is it that they want, don't want, they like, dislike. So you may not put a dishwasher. You may be looking at this 200 unit complex over here, and it's in a particular neighborhood, but don't put dishwashers over there because they don't use them.
Mm-hmm.
It's just a cultural thing. They're not going to use the dishwashers.
Mm-hmm.
But over here, you put the dishwashers over there, they're going to use them because they love it. They don't want to wash dishes. Put it in the dishwasher. So you have to weigh it out. There's certain ways you can improve. There's certain things that some investors look for, such as, are the rents below market? Can we push the rents? Okay.
Mm-hmm.
So there was a property that the rents were $866. That was the average, but we were able to push the rents to $950. See that?
Mm-hmm.
There was an apartment who they didn't institute RUBS, which is nothing but utility reimbursement. Okay,
Okay.
that's
Okay.
all it is. So we don't need to get too technical. Utilities reimbursements, everyone. That's what RUBS is. Utility reimbursement. You're getting your money back. They didn't have it, but now you go in and you implement it. Do you see how you're increasing the value?
Uh-huh.
You're increasing the value. You're implementing RUBS. You're doing renovation.
Which
The
means that the
cabinets.
people will pay more for the property.
Right. Exactly. And also, but you got to also look at the neighborhood. Make
Mm-hmm.
sure the neighborhood can support that, because you don't want to go into a neighborhood that may be less than 40,000. They may be making like 30,000. You're going to go in and put in $200, $300, $400 worth of, and you're not going to get your return on that, right?
Mm-hmm.
So what you will look at is, okay, renovation. Can we push rents off renovation? And then, that's why, um, even in a downturn, you should still raise your rents, even if it's by $1. And I was taught that from my mentor. Every year you should raise your rent, even if it's, he said, even if it's just $1,
Uh-huh.
you should raise that rent. Now, when you do that, that's another phrase. It's called forced appreciation, right?
Mm-hmm.
So, that's what, when you compare what we do, what you and I do,
Mm-hmm.
and compare that to the stock market, there's no comparison.
It's better, you get
There's no
better
comparison.
returns on real estate, at
Correct.
least from our perspective, because we're real estate people. Yeah, which makes sense. So, and then two, you get to control the income that you receive from it based on
Yeah.
the type of investment. So it's safe to say that when you look for deals, you're looking for properties that have been undervalued, and these are landlords who have maybe neglected the property, didn't really keep up with
Um,
the returns, or just who haven't decided to do the remodeling.
right.
So you
The
find
property,
those,
yeah. The
and then
property is
they,
just in some sort of distress, right?
yeah, and then at that point they're just
Mhm.
ready to sell for
Yeah.
who knows what reason. And then
Right.
that's when you're like, okay, let's write it, underwrite
Yeah.
it for you, see what the returns are, and then you make a decision based off that. And
Right.
then two, I had another question and it just slipped my mind. The returns. Okay, and then is it when you meet a certain threshold that you as far as dollar amount, is that when you decide to sell the property again, or do you hold it for a specific amount of years, and then once you meet that deadline for the years, that's when you decide to sell, and then that's when everyone gets the lump sum?
Well, listen, you don't only make money on the sell.
You
That,
make
and
money
yes,
on the buy.
you're going to make money. A passive investor is going to make money throughout that transaction.
Mm-hmm.
Because I consider, some may not, but I do. If I get a dividend for $800 every quarter, I'm not making money, and
Mm-hmm.
I know I'm getting my capital back.
Mm-hmm.
I made money.
Mm-hmm.
So so, but to answer your question, you're going to make money depending on the investment and depending on how it's structured, depending on the property, because all properties are not value add. Some properties are stabilized. You could go in and you cash flow on day one, right?
Mm-hmm.
So you go some properties you cash flow day one, you may get a dividend check the following month. Or if they set it up where you get a dividend check the next quarter, okay, that quarter. Or if it's a value add play, they may say we're going to hold all dividends for 2 quarters, then on the third quarter, we're going to go ahead and start giving out dividends, right?
Mm-hmm.
And that's what happens. So every quarter, every month, you're going to get some sort of cash back for you being the person who lend us your money.
Okay.
That's what that COC.
Okay.
But then you also going to get not just your cash back, not just as we say, not just that dividend, not just your equity back, but you're also getting back a portion of the proceeds
Mm-hmm.
from the sale. You're getting back some of that too. So that's why when you hear someone say we're going to 2x your money, that means you're putting in 100, we're going to give you back 200. If someone say we're going to 2x your money,
Mm-hmm.
right? You're getting part of that proceeds right along with your cash on cash every single quarter or however it was structured, and right along with that.
Sounds good. Sounds good. We covered a lot of information today. So let the people know who that are listening or watching. Tell them how to find you and website information, etc.
Sure, you can find me on LinkedIn at Darryl Murphy Senior. Um, and I'm also a member of the GOB network of apartment investors. You can find me through Jacqueline, right? You can reach out to her. We do have, if it's okay if I mention the mastermind.
Go ahead.
Okay. Every Tuesday at 11 o'clock Eastern Standard Time, we have a commercial multifamily masterminds. We meet, it's usually around 50. I think the minimum I've had is around 50 members, and sometimes it could get larger. But people, this is where we actually do deals. You look at them, we bring the underwrite, the raw material. You can ask questions. You could critique it. We helping these investors, the new investors, and everything. So if you really want, listen, if you want to take action, I mean take action. I'm not talking about sitting on the sidelines. If you really, really, really want to take action and get into the game, come to the commercial multifamily masterminds, because we have every Tuesday we're going to be presenting an underwrite. So the commercial mastermind is really it. And I'm one of
You'll
the
find me in
I'm
the
also,
group. I'll be in
yep,
there.
and exactly. And and we are affiliated with the GOB, and I am one of the founding members of the GOB.
All right, so there you have it. So there are multiple ways to get in contact with Darryl Murphy or myself. So if you like this video, hit like, subscribe on both mine and Darryl's. We both have YouTube channels, and then you can find yours under your name, right? Darryl Murphy.
Darryl Murphy Senior. And Jacqueline, you can share my email, Darryl@murphybaynardgroup.com. You can share my email with everyone who want to get in contact with.
And there you have it. So thank you again for joining me on another episode. And I'm pretty sure me and Darryl will talk again because we meet every Tuesday. All right, so you guys take care and we'll talk to you again soon. Bye.